Hello, everyone, and welcome to Fundamental Auditing, Chapter 8. Chapter 8 is going to introduce audit evidence and assurance, and then we're going to talk about audit documentation as well. So this chapter starts off explaining what the different types of audit techniques are to get the audit evidence that you need to ensure or to provide an opinion that the financial statements are free of any material misstatements. So we're kind of getting our feet wet in the type of evidence that we need for this chapter. And then from chapter 11 to 14 kind of digs deeper in the different types of cycles, like revenue cycle, purchases cycle, and goes through how to audit each one. So this is more general, and then we're going to go into the more detail in those later chapters. Okay, so there's different audit techniques that auditors use to gather evidence in order to make their opinion. So we gather evidence and create our audit procedures. So in your planning stage, you want to develop audit procedures for the high risk areas that you would have identified in your analysis of inherent risk and control risk. And then you're going to look at what procedure should we develop to, and what assertions are we testing. Okay, so different types: inspection, observation, confirmation, recalculation, reperformance, analysis, and inquiry are the different types of techniques we would use to get evidence. So inspection is inspecting any documents. So inspecting any documents from independent parties would be better level of assurance than inspecting documents prepared by the auditee. So if you're preparing documents by the auditee, they can, you don't know how reliable that is because the auditee is creating those documents. But if you look at independent parties documentation, then that's more of a reliable source of evidence. So for example, if you look at a loan agreement, you can look at the loan agreement that the bank provided or even get it from the bank to see if the right amount of liability is on the financial statements. You can also do a physical inspection. So instead of just looking at documents, you can look at assets. So you can do a physical inspection looking at the assets that the company has. So if they say they have 20 vehicles as part of their tangible assets, you can actually go and check, do they actually have 20 vehicles? So inspection is inspecting documents and doing physical inspections to determine what they're saying that is on their financial statements is actually there. The other one's observation. So the auditor kind of just walks around and observes what's happening. So this is, I guess what you have to recognize when you're looking at observation is when people are being watched, then they're more inclined to do things correctly. So if you're watching the accountant or bookkeeper put in an entry into the computer system, like they're going to want to make sure that they do that correctly and be really careful if they're being watched. So not the best evidence gathering, but it does help in some situations, especially when you're trying to gain an understanding of internal controls. You want to watch what's going on so you can understand them. And then confirmation is another one. Confirmations are statements made by independent parties. So you go to those, you ask those independent parties to provide a confirmation of a balance that's on the financial statements. So for example, accounts receivable. So if the client has all these accounts receivable balances from all these customers, you can get confirmations from those customers and ask them, okay, what balance do you owe the company? And they'll say, okay, I owe the company 100,000. And then you go check if the accounts receivable is 100,000 for that particular AR. So you confirm with third parties, independent parties, that the numbers on the financial statements are correct. Recalculation, reperformance. So the auditor recalculates something or reperforms a calculation. So a popular one for this is depreciation expense. So the client will record what their depreciation expense is, and then you as an auditor will redo the calculation. So do a recalculation of the depreciation expense to determine if it was correct. Same with like using the percentage of completion method. So you would want to do a recalculation there. Other things like if the allowance for doubtful accounts is 5% of sales, you can do a quick recalculation to make sure that they've done that correctly. You can do analysis. So we were talking about analytical procedures. So looking at data interrelationships, comparing last year's numbers from this year's numbers, comparing this year's numbers to industry numbers. So you're kind of doing an analytical review there. And then you can also do inquiry. Inquiry is you're going and asking questions to the auditee or the client or management, whoever's creating the statements. If you don't understand anything, you're going to go and inquire. Inquiry is not enough of an audit procedure. You do have to cooperate the evidence that the management is giving you. So if you go and ask management a question and they tell you something, you want to get some sort of other evidence. So either through inspection, observation, confirmation, recalculation. Inquiry is kind of like the first step. So you're trying to understand something doesn't make sense. You're getting the explanation from the auditee, and that's going to lead you to determine what your next step is. Right, so let me just dig into a little bit deeper for each one of these. So inspections, I said looking at records, documents, or assets. When you're looking at inspection, I guess the assertion that goes along with that is existence. So it helps determine whether the balances in the financial statements actually exist. So if you see that there's a revenue number of 50,000, you want to make sure that actually exists. So you go and look at the supporting documentation. Okay, or if on their books they say they have a building, you want to make sure that building actually exists. So you go and you actually look at the building, you look at documentation. It also supports valuation. So you're looking at records and stuff to determine if the value that they've recorded is correct. So documents can be prepared by independent outside parties. So you want to get documents that are prepared by independent people rather than the auditee. Sometimes if you're looking at customer invoices, so customer invoices would be prepared by the auditee, not by independent parties. So sometimes you can't. But when you can get independent documentation, you should. Also, what fits into inspection is doing some sort of scanning. So you're looking for anything unusual. So you're scanning the general ledger and determining if there's anything unusual in the general ledger. So I talked a little bit about this in a previous chapter, where you look at whole numbers, right? The retail companies that sell clothes, for example, they don't usually sell something for $30. They sell something for $29.99 or $29.97. So you want to just look at anything that seems out of the ordinary and follow up on that and raise questions. Okay. Computers can be used to scan electronic data files. So if there's a lot of data you have to look at, you don't have to scan through everything, and the computer can do that for you. So you can sort, you can filter, there's systems out there where you can do some data analysis. And scanning can be used to reduce some sampling risk. So if you can scan items that you didn't select for further review. So we don't look at 100% of documents or 100% of the entries, like journal entries or journal ledger entries. We look at a sample of them. So whatever is not selected, you can kind of quickly do a scan of them to make sure there's nothing unusual. All right, so still talking about inspection, there's something called vouching and tracing. So when we're inspecting, we're either vouching, so information is collected from an account or some sort of summary of information. So what you do, like you have numbers on the financial statements. Those numbers have, if you want to look into those numbers in more detail, you would look at the general ledger. So you would look at the general ledger for revenue, for example, that shows all the entries that went into the revenue account. So what you're going to do when you vouch, you're going to take an amount from the general ledger and then you're going to go and find the source documentation. So find the documentation, the backup documentation that's related to that item. So if it says that there was a transaction of revenue of 50,000, then you're going to go and find that invoice and look at the details of the invoice, look at the date, look at whether the products have been shipped or not. So maybe you're looking at shipping documents to support that item or that revenue amount of 50,000 actually exists. So that supports existence. Or the other way around is called tracing. So when you're tracing, what you're doing is you are going, excuse me, you're going from this, you're starting from the document. So what you're going to do is you're going to pick out an invoice, and then you're going to look at the invoice, see if revenue should be recorded by looking at the date and looking at the shipping documents if it's been shipped. And then you're going to look at the general ledger and make sure that that has been recorded. So tracing supports completeness. Okay, so within inspection, you can say we're going to vouch from the general ledger to the invoice and then to the shipping documentation, and we're going to look at this in the documentation. Or you're tracing, you're starting from the documentation and you're going back into the general ledger to see if it's actually been recorded. So tracing supports completeness, vouching supports existence. When you're writing up these audit procedures, you do need to be really specific and you need to explain what you're doing. So you can say, vouch, or you can say trace, and you want to say what documentation you're looking at, and you want to say what you're looking at in the documentation. So you don't just say, vouch from the general ledger to the documentation. You want to explain that it's an invoice you're looking at, and then you want to explain what is in the invoice you're looking at. Okay. Next one, observation. So looking at the application of policy and procedures by others. Okay, so what you're doing is you're at the time of observation, you're looking at what's being done. And you can do a tour of the company's physical facilities and kind of just, if it's like a machine shop or something, you can go tour, look at the machinery that they're using, just like observe what they're doing, and this will help you determine if like anything is impaired, like maybe some of the machinery looks very impaired or something. So you're just kind of looking around, seeing what people are doing. It is reliable evidence at the time of the observation, but you can't observe 24/7, so you don't really know what's going on when you're not observing. Talking about external confirmation, so you get written. So what an auditor does is provides a written inquiry to verify the accounting records. So they're going to send a written inquiry to independent parties. So, for example, they can send it to the bank and ask the bank what the year-end balance is in cash in the client's cash account. They can talk to some accounts receivable clients. They can talk to some suppliers and vendors to get reliance on the accounts payable number. Okay, so whatever we can confirm with independent parties, we would send them a letter, a written inquiry, and say, okay, can you confirm what is on your books for a particular transaction? And confirmation can provide evidence regarding a few different assertions, so existence, ownership, valuation, and then like completeness or cutoff. Okay. So confirmations should be printed on the client's letterhead. It should be signed by the client, but it should be sent out by the auditor. Okay, so it's basically coming from the client because if someone's getting this information, it should come from the client if they're asking what's the balance in the AR account for that client. The auditor needs to ensure that the address on the confirmation is legitimate. So if you're asking the client, okay, who is this customer? Like, can you give me the contact information of this customer? I want to confirm that on their side, the balance is correct. And if the client gives you an address, you want to make sure that the address is legitimate and not just, the address of one of the managements in that company, and then they're going to respond to the letter. So, you can do a quick Google search to see if that is the legit customer. If a customer is a business, you can Google search it and find out the business, if it is actually that business address. And the auditor must be the one mailing the confirmations. So if the client mails the confirmations, you don't know if they're being tampered with. So the auditor should mail the confirmations, and the auditor should get the return address should be of that of the auditor. So the client can't tamper with the information before it comes to the auditor. So there's two different types of forms of confirmations. There's something called positive confirmations and negative confirmations. Positive confirmation is what you want to give out, because a positive confirmation asks for a reply in all cases. So if you're talking about accounts receivable, so for customer A, there's accounts receivable balance of 100,000. So you send out a confirmation to client A or customer A and say, please reply back to this telling us how much money you owe the company. So that's a positive confirmation. Negative confirmation is only requesting a reply when the information is incorrect. So it's saying, okay, we have a balance of 100,000 that you owe the company. If this is incorrect, please provide us a reply. So negative confirmations don't require a reply unless the information is incorrect. A positive confirmation always asks for a reply. So it says, tell me what your balance is, and then we'll take that balance and compare with the balance that the company has. So because for negative confirmations, you don't know that if they're not giving you a reply, is it because the information is correct, or is it because they never got the letter, or they kind of threw the letter out, or they just decided to be lazy and not provide a return? Okay, so you're going to send out the positive confirmations. You might not get, even if you send out a positive, you might not get a reply. Like the client might decide not to reply to it, or the customer might decide not to reply to it. So you would have to follow up. So you'd want to follow up with these customers, maybe call them up or send a follow-up letter. If they're not still replying, then we would have to do other types of procedures on the AR balances. Okay, next one is the recalculation, reperformance. So you're performing independent calculations or recalculating whatever the client calculated. It does provide reliable evidence that they've done something correctly. It will address existence and valuation. So if you want to check if something's valued properly, do the calculation yourself as an auditor, and then compare it to what they've calculated, the client, and you'll be able to determine if they've done it correctly. Or reperformance. The auditor independently does a procedure and sees that if the way that they're doing the procedure is the way that the management has described the way that it's done. And then analysis or analytical procedures. So we talked about this in a previous chapter. So comparing current year to prior year, current year to budget. So, if they budgeted certain amounts, but then your year-end numbers are different from the budgets, you can ask why. Why is there a difference? Why is there such a big difference? Evaluating current year against other current year balances, comparing some financial ratios to industry standards. So you're doing all of this stuff to kind of figure out what areas you're going to get more evidence for, and where you're going to ask more of your questions. So analytical procedures is not enough of an audit procedure. It's basically how you start, and then that's going to form where are you going to go from there. What questions are you going to ask after that? And then inquiry involves getting oral evidence from the client and any like third parties. So evidence from inquiry does require corroboration. So you can't just rely on what the management is saying. You need to get some sort of other evidence. So again, inquiry is one of the first steps. You're asking questions, trying to understand, and then whatever the management tells you, you want to go and get more evidence to determine if what they're saying is correct. All right. Sometimes there's also like more different types of evidence you can get. So you don't have to just do, like, you wouldn't just do inspection, for example. Maybe you're doing inspection and confirmation, or inspection and recalculation. So you don't have to just do one test for each of those accounts. You usually do dual procedures. Sometimes a procedure is going to meet um, doing, testing whether the controls are being done right, and testing whether the amounts in the financial statements are correct. Sometimes you could do both in one procedure. So getting sufficient audit evidence. That's always a hard one to know how much evidence you actually have to obtain. Like, how much is enough evidence for you to gain reliance that the financial statements are free of material misstatements. Right? So and we need to make sure we get enough level of assurance or evidence to be able to provide an appropriate audit opinion. To be considered appropriate, the evidence that you get has to be reliable and relevant. So it has to be relevant in that it has to relate to one of management's assertions, so existence, ownership, completeness, valuation, presentation. Like, it has to has to relate to one of those, and it has to be reliable. So we have to make sure that the evidence that we're getting is reliable, and not like something that's fake, or just or oral evidence provided by management wouldn't be enough. You'd have to corroborate that. So the most reliable sources of evidence is actually doing, like, the auditor actually doing a physical inspection themselves, um, getting third-party confirmations, so going to customers, going to the vendors and suppliers and the bank, and actually confirming the amounts, looking at external documentation, so third-party documentation, and the auditor doing a recalculation or reperformance. So if the auditor is doing a recalculation of depreciation expense, then we can expect that depreciation expense that they've calculated is correct. Less reliable evidence, but still can be used, is like external / internal documentation. So you're getting internal documentation, but there's good internal controls in place, so that documentation could be more relied upon. Doing observations, doing analytical procedures, and the least reliable information is getting internal documentation when you know that there's poor internal controls, inquiry, and then just doing like broad analytical procedures. So I talked about how do we know how much evidence is enough evidence? There is not any official standards saying like this much evidence is enough. The auditor has to use their professional judgment and have to be comfortable with the evidence that they got, in order to stop getting more evidence. Okay, so can you persuade someone else that you've collected enough evidence to support your conclusion, is what they kind of look at. In order to reduce detection risk, which thereby reduces audit risk, more evidence is required to support an opinion, right? So if your detection risk is low, we need more evidence. So that was from chapter 6. So in order to reduce audit risk, only detection risk can be affected by the auditor. So then more evidence is required to support the opinion. Okay, so go back to detection risk to see how much evidence is enough evidence. I've been talking about doing an audit planning at the beginning of your audit. So there's actually like a planning document. It's called the audit planning memo, and that is where you provide all your planning of what you're going to do. Is you're going to figure out, you're going to do your preliminary analytical procedures. You're going to figure out what your materiality is going to be by doing a discussion on the users of the financial statements. You're going to look at your risk assessment and figure out what your inherent risk is, control risk, the detection risk, and audit risk, and then any specific other things that you need to know about the audit, like who the staff is going to be, what the time budget's like, so any independence issues, so anything in the planning phase has to go into an audit planning memo. Okay. So audit planning is done at the start of the audit, and then it continues as you get more information. So you can make some revisions to the audit planning memo if you learn something new. Maybe you find out about a new user, so you can put that in the materialities discussion, or you find out about a new risk. So the planning becomes the basis of the audit program. In your planning document, you're also providing what the audit procedures are going to be, and what risks and what assertions they're going to test. Okay, so the audit, so the planning is going to help you create the audit program, and the audit program is what provides what the specific audit procedures you're going to do to um, based on your risk assessment. Okay, and this can be changed and revised, but you want to plan it out what you're going to do before you actually go to the audit client and do it. So when you're looking at an audit program, the audit program basically is something you use to plan out your audit procedures. Okay, so the audit program plans out what audit procedures you're going to do. So you look at you look at the nature of the audit procedure. So what types of evidence are you going to be using? So inspection, observation, recalculation. You look at the timing. When are the procedures going to be performed? So some procedures can be performed throughout the year. Some procedures you have to wait till year end. And then the extent. What is the size of the samples you're going to use? So you're not going to audit all of the revenue numbers, for example. You're going to take a sample. So what type of sample is going to be used? Sampling we'll talk about in chapter 10, so we'll get to that soon. So there's 3 types of audit programs. One is a risk assessment program, which talks about the specific procedures that the auditor is going to do to get an understanding of the auditee's business and its controls, and how we're going to assess inherent and control risks. Okay, so like what type of procedures are you going to do to gain your understanding? So are you going to do like a walkthrough, an observation of how everything is done, who you're going to talk to, stuff like that. And then you do an internal control program. So you're doing procedures to obtain an understanding of the client's control systems. And this will help you assess your inherent risk and especially your control risk. And then you're going to do a balance audit program where you're going to actually get the procedures, you're going to plan out what the procedures are going to be to get the evidence on the dollar amounts and the accounts. Okay, so how are you going to get the evidence of what's on the financial statements? How are you going to prove that doesn't have material misstatements? Whenever you're doing anything in the audit, you do have to document it. So working papers need to be, so the audit documentation is called working papers. So you have to document everything that you're doing. So what evidence you're gathering, who's gathering the evidence, who's reviewing it, who's signing off on it. So working papers should contain all the support for all the decisions made throughout the audit. The auditor owns the working papers. We would need to get clients' consent before providing these working papers to third parties, unless it's like for a legal issue, the courts demand it, for example. Okay. So there's a permanent file, which is going to include just like the permanent information about the company. So anything that doesn't really change year to year. So maybe like who the board of directors are, what's the organizational structure, what's like the mission and what's the overall strategy of the company. Anything that doesn't change will go into the permanent file, maybe like the incorporation documents. The current file is your audit planning memo for the year, and then all like your evidence that you've obtained. So all the evidence you've obtained, what testing you did, and what the decisions were made. So you have to document through each step of the audit. So what's in the permanent file is any like partnership agreements, any contracts, including leases, bonds, like long-term contracts, any minutes from any shareholder meetings, schedules for like share capital, retained earnings, capital assets. So those would all stay in the permanent file. You're also going to have an administration file. So that's just like I was saying, like organization charts. You're going to have your engagement letter in there, which was the contract agreement between the auditor and the auditee. You'll have your staff assignments, who's working on the audit, any meeting notes that, so if you've had a meeting with your audit staff, so the meeting minutes would be included in this file. An internal control questionnaire. So this is something for you to ask management. So go through a questionnaire with management in order to gain understanding of the internal controls. And then you're putting your audit plan in there. You're gonna include the trial balance of the company gives you, any adjusting entries, any other notes will go into the administration file. Then you're going to have your audit evidence files. Your audit evidence are typically organized in sections. They're organized by account, right? So you're going to have your cash. You're going to have your cash account. So you're going to first have a document, or it's called a lead sheet, that shows what the balance in your cash is and what the balance was in the previous year. And then the next page is going to show what evidence you obtained. So if you got a confirmation letter from the bank saying this is the year-end balance in the bank for this cash account, you put that in there. You kind of provide your notes on what did you do, like how many samples did you test, what did you test, what did you find, what were your results, and you want to reference everything, so then you know where everything kind of leads back to. So everything needs to be referenced, so if anybody else is looking at your working paper files, they can easily follow along. And the evidence must also show what assertions were audited, what type of evidence were gathered, and what the final decision was. Okay. And it should also show like where the work was planned, right? So it should show that the work was planned, the work was supervised. So if you're a junior auditor doing like the cash section and testing that and finding the evidence, you would sign off that you did that work, but then you would have to have a supervisor signing off, somebody that's reviewed that work as well. So the documentation has to be done really well, and it has to be really easy to follow along. So there would be like an index that you would do. You would have page numbers. So if you took something out, you could put it back in the correct page number. There needs to be cross-referencing. So if there is a number on a third-party document, you would cross-reference that number to the number that's on maybe the bank reconciliation, right, to show where the number is coming from and where it's going. You would have like the headings, which would be what is the entity, like for each of the working paper files. Each of the files should have like the entity name, the period that's being audited, and whatever the title is. So if you're looking at if you're putting a bank reconciliation in your audit file, you want to have the name, the period, and then whatever it is. So bank reconciliation created by the client. So show what's been created by the client or what's been like third-party documentation. And then each page should have like a sign off, so initials from the auditor and whoever's reviewing it, the date of whenever you did the work and when you reviewed it, and then any like tick marks to show that work has been performed. So really detailed, really good organized working paper files, so that if anybody else is looking at that file, they can follow along really easily. All right, so that's the end of chapter 8. Thank you for listening and take care.